Once we have financial statements, we can look at interpreting those numbers. Financial ratio analysis is one of the most commonly used tools for measuring the firm's liquidity, profitability, and reliance on debt financing, as well as the effectiveness of management's use of resources. It also allows comparisons with other firms and with the firm's own past performance. Remember, our financial statements are created following GAAP, so we have this comparability. Ratio analysis helps us pinpoint areas that may need improvement, spot trends, and allows comparison with other firms and with the firm's past performance. You may wonder, can't we see all this by just looking at the numbers in the balance sheet or the income statement and not have to calculate ratios? The answer is no. Let me give you an example. Say I'm a landlord and I have a house to rent. I'm asking $2,000 a month. I have 2 people seriously interested in renting my property. I figure the potential tenant with the higher income can better afford my rent. So I compare their incomes to make my decision. The Jones family makes $100,000 a year and the Smith family makes $75,000 a year. I agree to rent to Jones because they have the higher income. But after a few months, the Jones family starts falling behind on the rent. Where did I go wrong? What I neglected to look at were their liabilities. What else do they have to pay in addition to my rent? Well, the Jones family has 2 car payments for over $1,000 a month, $25,000 in credit card debt, and Mr. Jones has child support payments to make. The Smith family, on the other hand, isn't carrying any credit card debt and their cars are paid off. Based on this information, I would have been better off with the Smith family. See, you shouldn't try to keep up with the Joneses. We would be making the same mistake when looking at companies if we only looked at revenues. Company A can have higher revenues or sales than Company B, but Company A may have negative profits because their liabilities are larger than their sales. So we can't look at balance sheet and income statement items in isolation. Ratio analysis helps us make these comparisons. This chart shows the different categories of ratios: liquidity, efficiency or activity ratios, leverage, and profitability. The following slides will go through each of these in more detail. Liquidity is defined as the ability to convert an asset to cash quickly without a loss in value. Liquidity ratios measure a firm's ability to meet their short-term obligations when they must be paid. So if I'm loaning you money, I want to know if you have the ability to pay me back. These are 2 commonly used liquidity ratios. We have the current ratio, which compares current assets to current liabilities, and we have the acid test or quick ratio, which measures the ability of a firm to meet its debt payments on short notice. The acid test or quick ratio is more conservative. It takes inventory out of current assets, since inventory isn't as liquid as cash and other current assets. Let me explain. Cash is the most liquid asset. It is ready to use to pay your bills, your short-term obligations. Accounts receivables represent money owed to the firm by customers for goods or services that have been delivered or used but not yet paid for. So we made a sale, we just haven't collected the money yet. Inventory, on the other hand, hasn't been sold. If we were desperate, we could probably sell it quickly to get cash, but would probably have to discount the price to do that. So inventory is not as liquid as the other current assets. Activity ratios measure the effectiveness of management's use of resources. We have the inventory turnover ratio here, which is the number of times merchandise moves through a business. The total asset turnover ratio indicates how much in sales each dollar invested in assets generates. Another activity ratio is the receivables turnover ratio. This shows how long it takes us to collect on our accounts receivables. The profitability ratios measure the organization's overall financial performance by evaluating its ability to generate revenues in excess of operating costs and other expenses. Here we see 3 profitability ratios: gross profit margin, net profit margin, and return on equity. Lastly, we have the leverage ratio category. Leverage ratios measure the extent to which a firm relies on debt for financing. Here we have our debt ratio and our long-term debt to equity ratio. Financial statements provide us with information after the fact. In order to plan effectively, budgets are used. A budget is a planning and control tool that reflects a firm's expected sales revenues, operating expenses, and cash receipts and outlays. Management has to make estimates of sales, cash inflows and outflows, and costs, and we do that by using those previously prepared financial statements. Budgets are a financial blueprint that serves as our plan. A cash budget tracks the firm's cash inflows and outflows. Here's an example of a cash budget. As you can see by the negative numbers in red, we have a shortfall in several months. This is useful to know so that we can plan for this temporary shortfall by setting up a loan or a line of credit to get us through. Accounting procedures and practices must be adapted to accommodate an international business environment. Fluctuations in currency exchange rates complicate accounting entries and practices. The International Accounting Standards Committee, IASC, established in 1973, promotes worldwide consistency in financial reporting practices.